As of the weekend close on Friday, May 26, 2026, Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, finished the regular session at exactly 46 cents, or $0.4642 per share, down roughly 8.45% from its previous close, with the markets now closed for the weekend. That drop capped off a brutal week where the equity shed roughly 25% of its value, leaving the market capitalization sitting right around $344 million. Here is what almost nobody is talking about right now. Datavault AI actually managed to beat its first quarter earnings expectations for 2026, delivering a net loss per share of -9 cents against the Wall Street consensus estimate of -14 cents. That is a 35% positive earnings surprise, yet the equity was absolutely slaughtered by institutional sellers who pushed it off a cliff during pre-market trading, and it never recovered. This massive divergence between an earnings beat and an immediate double-digit price collapse tells us that the general market expectation was completely detached from the balance sheet reality, creating a fascinating setup for individual investors navigating the microcap space. The common ground among small-cap tech investors is that any small firm slapping an artificial intelligence label on its business model is positioned for a rapid climb, especially when they claim to be transforming corporate assets into tokenized digital capital. People look at Datavault AI and see a tech business that just reported a massive 443% year-over-year revenue surge for the first quarter of 2026, alongside a restated full-year corporate revenue target of $200 million. The prevailing retail narrative says this thing is a massive bargain trading under 50 cents, especially with institutional analysts maintaining a long-term consensus target price of $3. But the contrarian take, the harsh reality that drove the massive post-earnings sell-off, is that the firm is bleeding cash at an alarming rate, posting a net loss of $53.1 million for the quarter, while carrying a heavy burden of corporate debt and relying entirely on speculative regulatory shifts to achieve its lofty full-year projections. When you look closely at the recent daily swings in trading volumes, you see an equity that has become an absolute battleground for short-term traders. The volume spiked massively following the May 2026 earnings announcement, revealing a rapid exit by risk-averse institutional players who were clearly unsettled by the company's massive operational expenses. Even though management tried to pacify the market by pointing out a newly secured $60 million registered direct offering and an additional $120 million in non-dilutive financing from Silex Holding, the street focused on the immediate dilution. In online investing circles, retail traders often treat microcaps like a lottery ticket, hoping a hot ticker will magically mimic the monumental historical run of Nvidia stock or the persistent retail momentum seen in Tesla stock. However, institutional asset managers look closely at structural liquidity and governance, and when they see a firm with a weak financial health score relying on private placements to keep the lights on, they pull their capital out without a second thought. This massive disconnect is exactly why relying blindly on basic metrics on popular investing sites can get retail traders into deep trouble. If you open up a standard online individual brokerage account or check your portfolio allocations on standard platforms like Robinhood or the SoFi trading platform, you might look at a 500% revenue growth figure and think you have found an overlooked gold mine. But seasoned investors utilizing professional tools like the interactive brokerage platform or diving deep into institutional fund holdings know that top-line growth is completely meaningless if the underlying operation costs more to run than it brings in. Datavault AI is currently trying to build out a massive 48,000 GPU quantum-ready edge network across more than 100 American cities, which is an extraordinarily capital-intensive project that requires constant inflows of fresh capital, meaning the threat of future equity dilution is going to remain a permanent overhang on the share price for the foreseeable future. Let us stop for a moment and look at the broader landscape of how retail capital interacts with these high-risk tech names. Comment below how many shares of Datavault AI you currently hold, or if you prefer sticking to large-cap names like Apple stock inside your individual brokerage accounts. The way capital flows between these speculative names and established blue chips is a key indicator of market-wide risk appetite. Right now, macroeconomic pressures are making investors hyper-focused on real cash flow rather than distant promises of Web3 data monetization. When interest rates remain stubborn and liquidity tightens, speculative assets get punished severely, which explains why the broader markets are punishing names like DVLT while pouring capital back into highly profitable safe havens. To truly understand why the equity is reacting this way, we have to look at the corporate structure and what this business actually does. The company was not always a pure-play data science enterprise. It was formerly known as WISA Technologies, which focused on wireless audio standards and data over sound systems. They underwent a massive corporate pivot, officially changing their name to Datavault AI Inc. in February 2025, after completing an asset purchase from a private holding firm. Today, they operate two distinct segments, an acoustic science division, which still handles the legacy wireless audio engineering, and a data science division, which focuses on their cloud-based platform designed to identify, value, and monetize corporate data assets using specialized algorithmic tools. They are attempting to separate these two entities entirely so that leadership can focus purely on the high-margin Web3 data exchange market, which explains their aggressive acquisition strategy, including recent deals for CyberCatch Holdings and NYIX to expand their digital asset exchange footprint. Just days ago, the firm announced a massive joint venture with Wildest Health to form a $4 billion platform called DelivMeds AI, aiming to combine pharmacy infrastructure, blockchain prescription tracking, and drone logistics. On paper, it sounds like an incredible concept that hits every single tech buzzword in the book, but the reality is that these massive, complex corporate tie-ups take years to generate actual free cash flow, and they face massive regulatory hurdles. This brings us right back to the central tension governing this equity. The expectation is a global digital asset exchange ecosystem, while the reality is a pre-profit microcap company that is heavily exposed to legal and legislative risks. Management openly admitted that their path to hitting that $200 million revenue target for 2026 is highly dependent on the passage of favorable digital asset regulations, like the Federal Clarity Act, meaning if Washington delays the legislation, the corporate timeline completely falls apart. For investors managing their own capital through self-investing strategies, this stock is a classic case study in systemic microcap risk. If you're building a balanced long-term portfolio using automated tools like Schwab Intelligent Portfolios, or holding safe, diversified instruments like Fidelity Investments, Fidelity ETFs, or Standard Fidelity mutual funds inside your Fidelity Wealth Management accounts, a speculative asset like DVLT has a microscopic place, if any at all. The underlying business model relies on convincing large corporations to pull their underutilized data out of secure silos and allow Datavault to assign a finite value to it for tokenized monetization. That is a tough sales pitch in a corporate climate where cybersecurity breaches are a daily headline, and corporate boards are terrified of regulatory scrutiny or data privacy violations. Even though their alliance with IBM to integrate specialized data governance tools helps legitimize the platform, the enterprise adoption rate is still far too slow to offset their current cash burn rate. Looking forward into the second half of 2026 and beyond, there are two distinct scenarios that could play out for Datavault AI. In the bullish scenario, the company successfully executes its corporate split, secures its regulatory approvals, and starts collecting massive transaction fees from the $750 million in tokenization contracts they have signed. If those fees start hitting the balance sheet as pure profit, the stock could easily rocket back toward the multi-dollar targets that institutional analysts have laid out on major investing sites. Conversely, the bearish scenario is that the cash burn continues to outpace revenue adoption, the company is forced to launch another massive dilutive share offering to fund its 48,000 GPU network, and the stock remains stuck in the penny stock doldrums, facing the continued threat of a NASDAQ delisting if it can't pull its share price back above the $1 threshold permanently. When you weigh these two outcomes against each other, the reality of the situation becomes very clear. This is not a set-and-forget investment that you buy on the Robinhood app or via SoFi Investing and ignore for 5 years. It is a highly volatile, highly speculative corporate turnaround story that requires active, daily monitoring. If you are tracking the ticker through a sophisticated individual brokerage setup like the Interactive Brokerage platform, you have to watch the institutional volume and insider trading filings like a hawk, because significant insider selling has already been noted over the past quarter, which is rarely a sign of immense short-term confidence from the people running the show. To wrap it all up, Datavault AI presents a textbook example of the constant battle between market expectation and financial reality. The expectation surrounding the stock is built on an incredibly ambitious, high-tech narrative of data valuation, blockchain pharmacies, and artificial intelligence infrastructure that sounds like the ultimate modern tech investment. The reality, as reflected in the 46-cent share price and the post-earnings collapse, is an unprofitable business fighting massive net losses, dealing with significant corporate debt, and dilution concerns that are currently overriding an impressive 400% revenue growth rate. For the smart retail investor, the lesson here is simple. Never let a massive top-line growth percentage blind you to the underlying operational expenses and cash burn of a microcap company, because on Wall Street, cash sustainability will always triumph over narrative. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.